I would say we're clearly past the first or second inning because I can remember not too long ago buying it at 13, 1400 with a vision of if it got to 2000 or maybe 2500, we'd be thrilled. I don't think any of us, even the most dire forecasters at the time, imagined a 3300 price getting to where we have and holding pretty well as well. I do think the consolidation now that is happening in it is very healthy if you believe in higher prices. In fact, the longer this would trade sideways between, say, 3,000 and 35, the more likelihood we can even eventually reach much higher prices. Everything that was constructive for it remains, and yet we still see little or no ownership by so-called mainstream.
PeterGrandich believes gold has progressed beyond the early stages of its bull market. Not long ago, prices were hovering around $1,300 to $1,400. However, gold is now trading firmly around $3,300. This steady climb reflects a structural shift in market sentiment, and the current consolidation range between $3,000 and $3,500 is seen as a healthy pause that could set the stage for further gains. According to Grandich, such consolidation often signals strength and typically precedes a breakout to new highs. On Wednesday, gold prices rallied more than 0.80% during the North American session. The move was primarily driven by weaker than expected economic data from the United States, including a slowdown in business activity and disappointing job numbers. This macroeconomic softness pushed XAU-USD higher, with the precious metal reaching $3,382 after briefly dipping to a daily low of $3,343. Adding to the bullish momentum are rising geopolitical tensions, particularly between the United States and China. Uncertainty surrounding the ongoing trade discussions between the White House and Beijing has increased investor appetite for safe haven assets, such as gold. At the same time, the US dollar weakened sharply, with the dollar index falling 0.44% to 98.81, which further supported the upward move in gold. Grandich highlights the gold-silver ratio nearing 100 to 1 as a strong bullish signal, indicating silver is deeply undervalued relative to gold. As the metals bull market gains traction and retail interest grows, he expects silver to see sharp upside. A decisive break above the $34 to $35 resistance could attract momentum traders and ignite a rapid rally. Currently, silver is consolidating near $34.50, trading flat within the $34 to $34.50 range. However, with higher highs and higher lows forming and resistance at $34.51 already breached, silver appears poised to test the key $35 level. A breakout there could pave the way for a move toward $37.49, its highest level since February 2012. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
I would say we're clearly past the first or second inning because I can remember not too long ago buying it at 13, 1400 with a vision of if it got to 2000 or maybe 2500, we'd be thrilled. I don't think any of us, even the most dire forecasters at the time, imagined a 3300 price getting to where we have and holding pretty well as well. I do think the consolidation now that is happening in it is very healthy if you believe in higher prices. In fact, the longer this would trade sideways between, say, 3,000 and 35, the more likelihood we can even eventually reach much higher prices. Everything that was constructive for it remains, and yet we still see little or no ownership by so-called mainstream Wall Street or mainstream media and all. And I really think until you start hearing it from getting in cabs and getting your hair cut and everything, we're not anywhere near other than past the first couple innings. We haven't even gotten midway to this. I still think there's multiple years left in this and 1,000 or 2,000 more possible to the upside. And keep this in mind. If you're in the other area of mining shares, most producers you would talk to say they'd be glad to take 3,300 for the next 10 years because their cost is so much lower and not likely to go up a lot. So there's also an importance to, other than the physical ownership, those who end up looking for it and develop it, how well are they doing with the current price? And I think they're all, we see it, Jesse, the top 10 to 20 major gold producers, almost all of them are producing record free cash flow. And they love that. And you clean up balance sheets real fast. And you also can start to make acquisitions from strength. And that way you could be, choosy on what you're doing. So all in all, I think the gold market still has a long way to go. They may be overbought from time to time technically, but I don't think they've come close to their highs. Like I said, I suspect from several quarters they are going to print record free cash flow. And I think what will happen, Jesse, is as the general equity market slows, and I'm not in the camp that thinks there's going to be a big crash in the stock market, but I also don't think it's going up a lot. Wall Street will always find reasons to buy something. It doesn't know how to do nothing. And what will happen is the generalists out there will start to see that the only real sector that's pushing out these record quarterly reports are these gold producers. And we're starting to see that now. We're starting to see some of the main brokerage firms and main people, big hedge funds buying interest in gold companies, talking about gold stocks. We've even seen it in uranium with Goldman Sachs getting involved. So I don't think the major producers have reached a peak. Where I have decided to focus, because I played the majors, and I several months ago and in the last few months put as much as I possibly could without getting a divorce into the junior resource sector. And even there, we're seeing now a lifting. So it's all systems go at this point. Yeah, they may get points where there's some consolidation and profit taking, but I think that market it's probably in an earlier stage than even the physical gold price. I actually think it's not all there. And if it is, it's been lent out kind of like the movie, the producers, more than one time. I think one of the things that I think we were going to see in what was early in the Trump administration was to see a repricing on gold to get it revalued, to give them some room on the treasury, and also to eventually introduce gold-backed bonds. I think that's one of the things they're going to have to do. I think the problem is when Trump talked about it, let's go there like almost on the next plane and see what's there. And somebody said, Mr. President, it may not all be there. And then they just totally stopped talking about it. And the argument that I give in support of Ron Paul is this: if it's all there, just show everybody. What do you got to worry about? You can end all the conspiracy books, everything. Let them come with testers, make sure it's not tungsten or what everybody else claims and all, and be done with. The very fact that they don't allows that conspiracy stuff to fester. And when you think about how they thought about it just a couple months ago and they pulled back, maybe there's something serious to it. Like I said, I think the other fear that they had was, without knowing first, maybe they didn't even know themselves, is somebody said, well, you remember what happened when Geraldo Rivera decided to open up that old Jimmy Hoffa safe, thinking, wow, everybody's going to see something, and nothing was there. Could you imagine doing a live broadcast and realizing the gold isn't at Fort Knox? The whole world would cave. It'd be the worst market crisis we've ever seen in our lives. So I think there's some realization, and I appreciate Ron Paul saying that. And, his father said it for as long as I've been in the business. And nobody ever went to do and get it done and just say, yeah, a couple of guys said, yeah, we saw one stack. No, take us through the whole place and let us reach wherever we want to reach and test. Then you don't have any problems. Silver bugs, especially back in the older days when I spoke at the conferences, hated it when I said it was like kissing your sisters. Not that I said not to own it, but I always put gold ahead of silver. However, several weeks ago when it broke under 30, I looked the way it was trading. I bought into the manipulation to the level that minimally there's people selling it hard at that level. It could be just because you keep selling it at a certain level until it finally breaks, or there's something more to the argument that it's been manipulated. There's not all the silver out there, et cetera, et cetera, et cetera. But also the ratio became important to look at. It is historic. Doesn't mean it's supposed to be always at a place, but historically when something traded at one level and now it's so on the other side of it, basically 100 to 1, it also brought interest. And my feeling was, as this bull market in metals matures and retail becomes more involved, they tend to move to more silver than they do gold, because it's more price sensitive and all. So all in all, it's a bullish factor, and it is trading, as you and I speak, extremely well. I think now it's a matter of days to no more a few weeks till we take out this resistance in the 34 and 35, and then that'll bring in general non-normal players, momentum players, etc., and that itself will create news, and that'll get the momentum going. And also, I think we're on that verge. It's not something I've I've ever said before. I haven't been a silver bull for decades almost, but I do think it's appropriate now.
One of the more perplexing narratives to emerge during Donald J. Trump's second term is his expressed desire to personally visit Fort Knox to verify the existence of the government's gold reserves. Despite the facility being one of the most secure and closely guarded sites in the United States, the former president has voiced concerns that some of the gold bars stored there might be missing. Trump has not offered any specific reasons or evidence to support these suspicions. His Treasury Secretary, Scott Bessent, sought to reassure the public earlier this year, telling Bloomberg in February that all the gold is there, delivering the statement directly to the camera in a pointed attempt to quell public doubts. However, Trump's fixation on Fort Knox has been somewhat eclipsed by controversies surrounding his family's involvement in various cryptocurrency ventures, which have triggered ethical debates and concerns over potential conflicts of interest. Still, his public questioning of the integrity of the U.S. gold reserves taps into a long-standing vein of conspiracy theories, many of which date back to the 1970s, that suggest not all of America's gold is actually in storage. PeterGrandich, a longtime voice in the precious metals market, argues that skepticism around Fort Knox is not entirely baseless. He points out that the continued refusal to conduct a full, independent audit of the U.S. gold reserves only deepens public suspicion. According to Grandich, if the gold is indeed all there, then an open and transparent audit would easily silence doubters. Let's get back to the interview.
Almost half of all financial advisors in the United States right now weren't even born when I started 41 years ago. The bulk of them have been only since the millennium started. And the reason I bring that out is, other than one or two short but significant declines, it's been a one-way street if you've been a financial advisor. So you can understand their buy the dip mentality, because so far each time it's worked. And it's in the same mode that it is now. You buy dips like what's occurred there. So it's going to take more than one dip before that breaks the camel's back in their eyes. But I think what's real important, Jesse, and doesn't get discussed at all, and I hope you don't mind me taking the time to, because I think it's extremely important. Those of us with gray hair or no hair, meaning that we've been in this game for decades, the market that we were once involved in doesn't really exist anymore. In 1984, when I started, almost 90% of the trading was just retail investors. And those were people that were just buying stocks to be part owners or selling up businesses. And only 10% or so was institutional, and there was no computer trading of any type whatsoever. Now, over half the money that's in equities is in passive funds. And these are funds that are tracking indexes and indices where the manager, he or she, only has discretion to purchase certain stocks that make up those indices and keep tracking whatever that index or indice is performing. It's not any room for individual, well, I won't buy as much of this or sell this. And that has, in a sense, self-fulfilling prophecies. As more money kept coming into these funds, the manager couldn't even say, no, let me hold some in cash. No, they had to put it to work. And a lot of it was concentrated in the higher echelon technology in the S&P 500, which happens to be the biggest index that is used in these passive funds. The issue with that is one day the reverse will happen. And the manager's not going to be able to go, no, I don't want to sell these stocks. They're too good. They're going to have no choice. That's very, very important to understand. And then think about where the other half of the money is. I would argue 2/3 of that remaining half is in computer algorithm trading programs. Some as simple as trading based on words used in headlines to trigger programs, to some very sophisticated that will use all sorts of delta spreads and options and futures and simultaneously selling. Those old Grandich guys with no hair or gray hair, they make up a smallest part now, retail, that is still buying stocks for part ownerships of businesses. So I think the first thing most people have to do now is get out of that mentality from 30 or 40 years ago and understand the game and what the board exists now. For instance, in our financial shows networks here, Jesse, they're being shot from the New York Stock Exchange. That might as well be a museum, because so little of the trading actually takes place there anymore. And so I think we have to understand how different the game has changed and what influences it. And therefore, to answer your question about, will the stock market ever go down or whatever, I think we have to look at a couple of things. One, go back to what the Secretary Treasurer said, who owns the assets? The top 10% of wealthiest people own most of the assets. That means they also own most of what makes up the stock market. What's interesting of late in these last several months, going into the latter part of last year, it shows the very, very wealthy are been selling U.S. assets and parking them elsewhere. I think that's interesting. The second thing I think that's important going back to is that what I said earlier, most financial advisors really are one-way street drivers. So far, that's worked for them. Someday, for some reason, it won't work anymore, just like it stopped working in the bond market. If and when that day comes, the lack of experience to know suddenly how to drive on a two-way street or your first time that you're approaching a traffic circle or a roundabout, that's probably going to cause more downside pressure than otherwise. So like I say, when I combine that all with my other economic, political, and social aspects on how I look at the markets, I think the U.S. stock market especially is fully priced and no reason that I feel I have to chase it. I probably argued if we were able to look at those people that you referred to, those who said it's the art of the deal and he knows what he's doing probably wear MAGA hats. And those who say he has no idea, he's a lost cause, whatever, are suffering from the Trump syndrome. I know that because I'm neither. I'm in the middle. And I get it from both of them why I should be much more their way than I currently am. This is how I describe it, and I just described it to our clients. And I'll say it to you, and that is, on some aspects, I think he's done a great job. I think he fixed an immigration problem that if it would have existed for a few more years, America would be in a far worse shape than it currently is. I think what he recently did in the Middle East is very encouraging. An area where peace has been hard to find, it seems to me that is a better possibility now than it's been since I've been an adult. Where I've totally disagreed from day one, and my record would show it, is I've been a big believer that the world was moving away from the dollar and the U.S. long before it came the topic of the day. 3 years ago, I embraced the BRICS argument, and that's what helped lead me to be so bullish on gold. I believe that's not only going to continue, but I believe what Trump has done has actually made it better for that to happen, not worse over time. I think he made the mistake of taking a bully attitude with a big stick versus walking with an olive branch and trying to express that, okay, listen, maybe we haven't done everything right, but is there a way that we could work this out for the benefit of both of us?
Gold's ascent past the $3,000 threshold reflects a more profound shift in global investor sentiment, underpinned by economic headwinds, geopolitical instability, and growing mistrust in official financial narratives. While prices consolidate, this period may represent a crucial buildup before another significant upward move. Silver, too, stands at a critical inflection point, with technical signals and relative undervaluation hinting at a potential surge. Meanwhile, rising public scrutiny over national gold reserves has rekindled long-held debates about transparency and trust in monetary institutions, raising broader questions about fiscal accountability in an era of shifting power dynamics. Is the growing demand for verification of gold reserves a reflection of broader skepticism toward financial governance? And could this mistrust be fueling the renewed strength in precious metals?